Welcome to The Deep Dive, your shortcut to being truly well-informed. Today, we're dissecting a really polarizing crypto project, HEX. It provocatively calls itself a blockchain certificate of deposit. Our mission is clear. Unpack its bold claims, look at the tech underneath, and critically analyze the, intense controversies surrounding it. There's quite a bit here.
Absolutely. And to get a truly informed view on something like HEX, you really have to look at all angles. We'll be drawing from all sorts of sources today: independent technical audits, raw market data, community chatter, even official regulatory filings. The goal is to give you a comprehensive, impartial look at a digital asset that certainly made some noise and sparked a lot of debate.
Okay, let's kick things off with something most people know. The traditional certificate of deposit, the CD, we think of them as, pretty stable, right? Safe, guaranteed returns, usually. It's a huge market, too, something like $7.2 trillion globally in 2023, maybe hitting $9.4 trillion by 2030. A real fixture. Now imagine taking that basic idea and putting it on the blockchain. That's sort of the HEX pitch.
Exactly. HEX is designed to work like a CD, but it runs entirely on the Ethereum network. It's an ERC20 token that's just a technical standard, basically meaning it uses Ethereum's infrastructure. So users stake their HEX, they lock it up for a fixed time, and they're meant to earn rewards, just like a bank CD. But the numbers they talk about, they're quite different.
Right, and this is where it starts getting really interesting. How do the reported returns actually stack up against old school CDs? Our source material dives into this, using an example starting with 1 million HEX bought at about Zixfona 006. And across the board, really, short-term, long-term, up to 15 years, HEX claims way high returns.
Yeah, it's pretty dramatic on paper. Like a traditional CD might give you, 0.5% to maybe 1.5% APY short-term, maybe 3 or 4%, very long-term. But HEX staking, according to its supporters, you're looking at maybe 8% APY short-term, rocketing up to 46, 47% APY for the super long commitments. The potential ROI they mentioned for a 15-year stake is, over 700%. It sounds incredible.
But, and this is a really big but, you can't just look at those percentages, can you? These reported returns absolutely depend on the price of HEX itself. It doesn't just have to stay stable, it has to stay above certain price floors.
That's the key caveat. For example, just to match a basic 0.5% CD return on a short stake, the HEX price apparently needs to stay above 0.000599. For that huge 15-year stake ROI to beat a 15% traditional CD return, the price floor is around 0.000085 ounce.
So it's like a high wire act. The potential reward is massive, but it's tied directly to the speculative price holding up, even at those lower levels.
And that leads into a core argument from people who support HEX. They claim that, even if the HEX price drops, it can still produce returns equal to or better than traditional CDs, provided the price does not drop below certain levels. So it's not just a blind promise of huge gains. They present it as a calculated risk. There's this idea of built-in resilience up to a point. It makes you think about risk differently, not just the upside, but that specific downside threshold.
Okay, so how does the staking actually work? Beyond the numbers, what's the mechanism?
Right. So users commit their HEX tokens to a smart contract. They choose how long, anywhere from 1 day up to 5,555 days. That's roughly 15 years. When you stake, you get something called T-shares.
T-shares?
Yeah, think of them as your slice of the future reward pie. The more T-shares you hold, which depends on how much HEX you stake and for how long, the bigger your share of the daily interest paid out in HEX. The system really pushes you towards longer lockups.
And I assume there are penalties if you pull out early.
Oh yeah, definitely. Early withdrawals get penalized, sometimes heavily. It strongly discourages breaking that commitment.
What's quite interesting here is that HEX actually got a smart contract audit. CoinFabric did one back in December 2019. That gives us a peek under the hood, technically speaking, from an outside perspective.
Indeed. And the CoinFabric audit, it had some important findings. Critically, it found no critical or medium severity issues. That's generally seen as a good sign for the core code security. But they did flag 3 minor issues. One was about how certain transaction signatures could potentially be misused. The HEX team apparently fixed that pretty quickly by tweaking a security parameter. Another pointed out that for really, really long stakes, the calculations might use too much gas. That's like the transaction fee on Ethereum. It could potentially make it impossible to end the stake.
Oh, okay.
So they addressed that by setting that maximum stake duration to 5,555 days, about 15 years. It was a practical fix due to how Ethereum works. The third minor point was about some unused code being marked as payable, which the team felt was unlikely to be an issue in normal use. The audit also has some suggestions for enhancements, like better naming conventions for functions, better documentation, things like that. Shows it went through some technical checks.
Okay, but now, here's where things get, let's say, really interesting. Because despite the tech side and those big return promises, HEX is surrounded by some major controversies and heavy criticism. It's really important to bring the site into focus.
Yeah, absolutely. And the central figure here is the founder, Richard Hart. Our sources highlight his background, including a previous name, Richard James Schuler, and his past involvement in, well, early internet marketing and email spamming, which apparently resulted in a lost lawsuit back in the day. That history tends to come up.
And his marketing style for HEX itself has drawn a lot of fire. Sources describe it using terms like aggressive tactics and exaggerated claims. I mean, apparently boasting of returns as high as 11,500% in some ads.
Wow.
Plus, there are quotes attributed to Hart himself where he sort of acknowledges using tactics a scam might use. That's quite a statement. It immediately flags a whole different kind of risk, doesn't it?
It certainly does. And the most significant challenge by far came in July 2023. That's when the U.S. Securities and Exchange Commission, the SEC, filed a lawsuit against Richard Hart.
Right, the SEC lawsuit. That's huge.
It is. The SEC accused Hart of failing to register HEX and also two related projects, PulseChain and PulseX, as securities, which is a big deal legally. But it went further. They alleged he defrauded investors, specifically misappropriating at least $12 million of investor money to buy luxury goods.
Like what?
The filing mentioned things like sports cars, very expensive watches, and even a unique 555-carat black diamond known as the Enigma.
A 555-carat black diamond? Seriously?
Apparently so. And as of late 2023, there were reports the SEC was actually having trouble serving him with the legal papers. They were seeking help from Finland's Ministry of Justice because he was believed to be residing there. Adds another layer to the drama.
And when you look at the market performance and what people are saying, it's just night and day, completely divided. The price history is wild. It hit an all-time high of over 55 cents back in November 2021. Today, it's trading around 0.0001. That's a drop of, 99.65% from the peak?
An enormous drop.
But then again, it's also up over 13,000% from its all-time low in December 2019.
Right. It's this bizarre financial paradox. Depending on your entry point, it's either total devastation or an incredible gain.
The market cap tells a similar story, maybe a bit more sobering. From a peak of $84 billion down to around $620 million a couple years later. And the community reflects the split perfectly. You see people online calling HEX a yield giant, saying it's going to be viral. Some users boast about being 200% up or claim HEX somehow beat the SEC in court, which seems premature given the ongoing case.
Yeah, that seems like wishful thinking.
But then you flip over to places like Reddit, and the criticism is brutal. People calling it the worst thing to ever happen, a scam, a Ponzi scheme, lots of stories about lost money, and descriptions of a cult mentality around it.
It's incredibly polarized.
There are also these concerns about illusory wealth, meaning even when the market cap looked huge, like billions, the actual daily trading volume reported by places like CoinMarketCap was often less than $10 million.
Which is tiny compared to its supposed valuation.
Exactly. For comparison, Ethereum might have a $200 billion market cap, but trades over $27 billion daily. The liquidity difference is massive. It raises questions about how real that valuation was.
And you mentioned PulseChain and PulseX earlier. Those are important parts of the story, too, also founded by Richard Hart.
Right. What was the idea behind those?
Well, the stated purpose was to create a sort of copy or fork of Ethereum, aimed at addressing issues like scalability and transaction fees, designed to be compatible with HEX and with its own built-in decentralized exchange, a DX.
Okay.
But, surprise, surprise, they're also steeped in controversy. Similar accusations of resembling scams or Ponzi's follow them too. A big point of contention was the sacrifice phase for their launch.
Sacrifice? What does that mean?
It means users basically sent crypto over $1 billion worth, reportedly to specific addresses associated with the project, in expectation of receiving new PulseChain or PulseX tokens later. But it wasn't an investment in a legal sense. You just sacrificed your crypto.
So you gave away money hoping to get something later? Essentially, yes.
Yeah.
With no guarantees. And over 2 billion HEX tokens got locked up in those sacrifice wallets, removing them from circulation, which could also impact the HEX price. And since that SEC lawsuit landed, the official launch of PulseChain has been, delayed indefinitely, although you do hear from some community members that a blockchain and an exchange are technically up and running in some form. It just adds more uncertainty to the whole ecosystem.
So, okay, let's try and tie this all together. What does this really mean for you listening right now? We've seen this dual nature of HEX, haven't we? On one hand, a project with this innovative, maybe audacious blockchain CD idea promising huge returns, and it passed a technical audit with, relatively minor issues flagged. But on the other hand, it's tangled up in massive controversy, a major SEC lawsuit, accusations of fraud, market collapse, a really divisive community. It's high stakes all around. Which brings us back to that fundamental point, risk. Cryptocurrency is inherently risky. One of our sources puts it bluntly. This is not financial advice. Do your own research, DYOR. It really hammers home that you need to carefully consider your risk tolerance and goals before jumping into something like HEX staking versus, say, a boring old traditional CD. Those headline-grabbing returns are tempting, no doubt, but they often mask equally significant, sometimes less obvious risks.
I totally agree. And it really underlines how important critical thinking is here. In a space like crypto, where things get hyped up, emotions run high, claims are often wild, how do you actually apply that critical thinking? This whole deep dive really reinforces that need to look past the flashy promises, dig deeper, especially when markets are this volatile and, frankly, this contentious.
And maybe that leaves us with a bigger question, something for you to think about as you navigate not just crypto, but the whole information landscape today. In a world full of products promising the moon, financial or otherwise, boasting about flawless tech, how do you genuinely tell the difference between real, groundbreaking innovation and just really, really aggressive marketing, especially when those lines seem intentionally blurred and, well, the stakes can be incredibly high?
That's a powerful thought to end on. Keep these insights with you as you make your own decisions and continue your journey to being truly well-informed.